Once investors understand that green hydrogen at ports behaves more like infrastructure than technology, the next question becomes obvious. Why does capital consistently show up at ports first? This is not coincidence. It is not marketing momentum, and it is not policy enthusiasm alone. Capital flows to ports because the risk profile there is fundamentally different. In infrastructure investing, capital does not chase novelty. It chases alignment. Alignment between supply and demand, alignment between regulation and operations, alignment between risk and control. Ports offer more of that alignment than almost any other location in the green hydrogen landscape. The first reason capital flows to ports is that ports already sit at the physical landing points of renewable electricity. Offshore wind does not land in the countryside. Subsea cables come ashore where heavy infrastructure already exists, where grid substations are permitted, and where industrial demand can absorb large volumes of power. That is almost always a port. As renewable penetration increases, these landing points experience congestion. Power cannot always move inland fast enough. Curtailment becomes routine. In some cases, electricity prices collapse or even turn negative. From an investor perspective, this is not a problem to be solved later. It is a mispricing opportunity today. Green hydrogen converts that stranded electricity into an industrial input at the point of congestion. This matters because electricity is the dominant cost driver of green hydrogen. When power is cheap because it has nowhere else to go, hydrogen economics improve immediately. Not everywhere. Only where that congestion exists. Ports concentrate that condition. This is why inland hydrogen projects often struggle to replicate port economics even with the same technology. The electrolyzer does not create the value. The grid condition does. The second reason capital flows to ports is demand certainty. Ports already host industries that consume hydrogen continuously. Refineries, chemical plants, and fertilizer facilities operate 24 hours a day because downtime is extremely expensive. These industries already rely on hydrogen as a core input, usually produced from natural gas. Green hydrogen at ports does not need to convince someone to start using hydrogen. It needs to convince them to replace an existing supply. That distinction changes everything. Replacement markets are easier to underwrite. Demand already exists. Volumes are known. Interruptions are unacceptable. For investors, this translates into higher confidence in utilization. Utilization is where most hydrogen economics live or die. An electrolyzer that runs intermittently produces expensive hydrogen regardless of how efficient it is. An electrolyzer that runs most hours of the year behaves more like infrastructure. Ports naturally favor high utilization because the industrial processes they serve do not turn off when markets fluctuate. The third reason capital prefers ports is transport economics. Hydrogen is extremely sensitive to distance. Compressing it costs energy. Liquefying it costs even more. Trucking it adds operating cost and risk. Long pipelines require capital, permitting, and time. In many hydrogen projects, transport costs quietly overwhelm production economics. Ports remove much of this friction by default. Hydrogen is produced and consumed within the same industrial zone. Pipelines are short. Pressures are controlled. Safety systems already exist. When hydrogen does not have to travel far, the system cost collapses in a way that models often underestimate. From an investor's perspective, every kilometer removed from the hydrogen value chain removes uncertainty. That is why port projects move faster toward financial close. Carbon exposure reinforces the pattern. Ports concentrate some of the most carbon-intensive and export-exposed industries in the global economy. These industries are not decarbonizing out of preference. They are responding to commercial pressure. Border adjustment mechanisms, buyer requirements, and long-term contracts increasingly penalize carbon-heavy production. Green hydrogen allows these industries to remove carbon risk at the point of production, rather than offsetting it later. That turns hydrogen into a defensive investment. Defensive investments protect revenue and market access. They do not rely on optimistic forecasts. Boards approve them more readily and lenders view them more favorably. Permitting and institutional alignment add another layer. Ports already operate under strict hazardous materials frameworks. Hydrogen does not introduce a new risk category, it fits into an existing one. Emergency response systems, zoning, and liability structures are already designed for flammable gases and high-pressure systems. This reduces development timelines and execution risk relative to greenfield or urban projects. Investors understand that time is risk. Shorter timelines mean fewer chances for policy changes, cost escalation, or community opposition to derail a project. Taken together, these factors explain why capital clusters around port-based green hydrogen projects, even when the broader hydrogen market appears uncertain. Investors are not betting on hydrogen everywhere. They are betting on hydrogen where system alignment already exists. This also explains a pattern that confuses casual observers. Many inland hydrogen projects receive announcements, grants, and publicity but struggle to close financing. Meanwhile, quieter port projects advance toward execution with less fanfare. Capital does not follow noise, it follows structure. The critical insight for investors is that green hydrogen is not a single market. It is a collection of location-specific opportunities. Ports represent one of the few places where power conditions, demand certainty, transport economics, carbon pressure, and permitting alignment converge. This does not mean every port project works. Execution still matters. Overbuilding, misaligned offtake, and poor integration can destroy value quickly. But when projects fail at ports, they fail for identifiable reasons. That is a much better risk profile than projects that fail because the system itself never supported them. For investors looking to understand where green hydrogen becomes investable infrastructure rather than speculative transition narrative, ports are not just early adopters, they are filters. They show where hydrogen survives contact with reality. Understanding why capital flows there first is the foundation for identifying which projects deserve deeper diligence, and which ones never will. At this point, most investors realize that evaluating green hydrogen requires more than tracking announcements or technology curves. It requires understanding system alignment, utilization risk, and execution constraints. That type of analysis is what we focus on at H2 Hub by Renee Energy for investors and advisors who need to separate bankable projects from optimistic ones.